Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we will actually discuss tax considerations in private company transactions. So we have the privilege to discuss these issues with a tax accountant and business valuation expert in Franklin and Nashville, Tennessee, Brad Smith. Welcome, Brad.
Hi, Melissa. Thank you for having me.
Yeah, so this is a great topic that we see a lot of people dealing with when they go to sell their business. They get maybe a purchase price. They then are kind of trying to figure out what do they have after that purchase price. So somebody could offer you $2 million for your company, but then what are the tax consequences of selling that company?
Yes, ma'am. Yes, ma'am. Huge question, huge issue, huge planning opportunity. For most business owners, this is probably the largest financial transaction of their life. And it's something that you want to get right. And you need to dig in and understand the details. And value is not everything. The terms of the deal and what you walk away from at the end of the day, that net after-tax benefit is extraordinarily important. So it requires a lot of effort and attention.
Well, and I think that what happens is somebody goes to sell their business, or what we're getting a lot of is that really successful businesses are being approached by buyers and saying, hey, we've watched you, you've had a 30-year business track record, and we'd like to buy you. But they kind of come into there with, we'll buy you for this amount. And the business owner has no clue of what they're getting. So then we have to kind of transition and talk to them about purchase price allocation. And
Sure.
How does that, in your perspective, how does it impact the transaction?
Well, significantly. And this is where your transaction advisor can really bring value to the table. So there's a multitude of things that can go on, and every company is different. But basically, big picture, the purchase price allocation is a means for assigning the total deal price to the underlying assets of the company. And let's taking a step back, assuming this is an asset sale. That's probably the easiest example. The tax code under Section 1060 actually requires that we follow a certain procedure. It's called the residual method. And the government gives us 7 classifications of assets that we need to utilize in this division. We start with cash equivalents. We work our way through marketable securities, receivables, inventory, fixed asset items. Then we get into the intangibles, which might include items like non-competes, patents. And then, interestingly, the final category is goodwill, which is kind of a leftover, right? So unlike you, Melissa, the IRS cannot evaluate goodwill with precision. So they make us follow this methodology. Now, that's not to say that we can't define the value, but it is a proactive element. I've been involved with a number of engagements where I was not maybe the transaction advisor, but I was just the CPA helping sort it post-closing, and leaving your purchase price allocation as a post-closing event can result in some unfortunate outcomes for sure.
Mm-hmm. And I think business owners kind of understand their inventory. They understand their accounts receivable, and then they have like their fixed assets, which is their actual things, furniture, equipment and such. But the goodwill is basically what's left over a lot of times.
Right.
So it just comes, and so I think most people conceptually have an idea of what goodwill is, or that it's a component of the company. Mm-hmm. But what are some of the tax implications of goodwill in the sale of a company?
Sure. So like you mentioned, if goodwill is organic, meaning it's been internally created, the business owners aren't seeing it on their balance sheet. It's not something that the accountants have posted. and that
there's no line item.
No line item. Unless they purchase the business, there's generally no goodwill on the balance sheet. Hopefully, the goodwill is the largest asset they have in their purchase price allocation. That means there's tremendous value that's being transferred to the seller. So the good news is that for the seller, goodwill is a capital asset. So it's for federal tax purposes. It is going to be granted long-term capital gain treatment under current rates, 15 and 20%. So that's about the best we can hope for. With respect to companies in various states, there can be some planning opportunities with goodwill. And one potential is bifurcating goodwill into a business component and a personal component. And so depending on the engagement and the location of the company, in Tennessee, for example, there is opportunity if we can isolate that personal goodwill. While we get the same federal tax outcome, we might save a tremendous amount of dollars in state tax. So I've done deals in Florida and in Tennessee. In Florida, that's kind of a neutral issue, but in Tennessee, it is an issue. And it is something that we have to actively pursue.
And part of this is understanding the difference between personal goodwill, which is kind of attributed to the owner,
yes, ma'am,
and enterprise or company goodwill. And there's a lot of different terms for it. But in essence, it's goodwill that is associated to the company, its reputation, its client relationships, all of that type of stuff that we're trying to distinguish because there's tax advantages for it being personal goodwill as opposed to corporate goodwill.
Correct. And from a buyer perspective, goodwill is required to be treated a certain way on their books. So regardless of the business or personal classification that we end up assigning it for purposes of the transaction, the buyer's in the same position. So it's a good topic because you generally have little to no pushback from the buyer on that item.
And what we've seen even in deals, just so, because a lot of people, you know, if they've been running their business for 30 plus years, they really may not have sold or bought a business before.
Right.
And so some of it comes at the very beginning that you're trying to determine the purchase price, and there could be an allocation. Like, so they'll then give you an allocation, and that's the time to really start negotiating those pieces as opposed to after the sale. I think that's what you said earlier.
Absolutely. It's a LOI or pre-LOI event, not a post-closing event. The Internal Revenue Service requires that both buyer and seller complete a Form 8594 where they record and agree on what those final allocations are. And so it's real important that everyone get on the same page. And part of our due diligence, if we're representing a seller, is to really go through those assets and understand what levers we can pull and what sensitive areas might exist. So you can have a client that may have a lot of equipment, depreciable property, and with these accelerated depreciation options that we have and have had for quite a while, their basis in these assets could be very low, but the value of those assets could still be significant. And so the seller needs to understand that there is a recapture component of that creates ordinary income to them based upon that allocation. So that can become a very sensitive matter that we want to work through, for sure.
And this, we've kind of skipped ahead, but one thing that I think might also be of interest to people is if you could just briefly describe kind of the difference between a stock sale and an asset sale, because buyers like one and sellers usually like another. And so maybe if just on a high level, because it's usually is a there's tax consequences that are favorable to each party on each different, a stock sale is what sellers prefer, but buyers prefer an asset sale. Talk to us a little bit about why buyers prefer that asset sale.
Well, sure. So, I mean, basically, it comes back to that purchase price allocation and the buyer getting a new basis in all of those acquired assets. Everything from the depreciable property to the amortizable intangibles like goodwill, they get a new starting point for future deductions. So it's definitely a tug of war between buyer and seller to find that middle ground that works for both parties. So an asset sale, incidentally, also covers the acquisition of a disregarded entity, which is something I see more and more. But an asset sale is a little more direct if the selling entity has non-operating assets or assets that they want excluded. Variety of reasons. It is certainly a very direct way to transfer an ongoing business and allow the buyer to be selective about what they're taking. But conversely, an entity sale, which could be a stock sale, or perhaps the membership interests in an LLC, taxed as a partnership, those are becoming more and more common as well. And it really hinges on items that are very difficult to transfer. And it could be customer contracts that would be too difficult to repaper. Is one example. A tremendous amount of titled property, like a fleet of trucks. There can be tremendous costs in moving all of those to new ownership. So an entity sale is very viable. And what is interesting is under the tax code, we do have elections available to us to treat a stock sale like an asset sale. So I never let the form of the transaction or the desired form slow us down. There are options that we can work through. It's just important that both sides understand the metrics and the pros and cons of what it means for both of them.
Yeah, and sometimes buyers just default to an asset sale. Yeah. Like that's just normally what they want, because sometimes when you have to do a stock sale or buying the whole company, you also have some of the liabilities that come, like not liabilities like debt, like, you know, something happens in the future based on a sale from a year ago, they might have to have a warranty or some other issue that they have to deal with that they don't always like to do. So I think that that's why they, you know, one of the reasons, but definitely at the beginning is when all of that conversation happens. What type of deal it is, what is the purchase price? I talk to a lot of business owners and say, you know, when you get that purchase price, whatever you're going to get at the closing table, you should be very happy with. And then anything in addition is kind of icing on the cake. So let's say the buyer, and the icing on the cake is usually called, in a better term, an earnout. So let's say the buyer wants to include an earnout in the terms of the sale. What are the tax ramifications for that? And maybe you can even describe a little bit of like what an earnout looks like.
Sure. So an earnout is really a risk mitigation technique, right? So we've got buyer and seller coming together. They're looking to transfer value, and that value may come in the form of continued relationships, whether it be contracts, customers, a variety of factors. And that forward-looking, that continuation is vital to supporting maybe the total value assigned to that transaction. So earnouts are very common, and pre-COVID, they certainly had a role. I'm noticing in deals that we had in the pipeline post-COVID or in the current environment that we find ourselves, their meaning has expanded somewhat. And again, it's all just about balancing risk. So from a tax perspective, the earnout is either classified as a contingent purchase price, which should be a capital gain item, or it could be considered compensatory, which is an ordinary income item to the seller. The other way it would meet that type of definition is if the seller is required to perform certain services post-closing. Okay, so the intent of the parties and the language of the provision governing the earnout is really going to determine how it's going to be treated for tax purposes. So my role is to make sure that we clarify, again, this is all LOI, an LOI event. We want to build into the letter of intent the nature of the earnout and what the intent of the parties is going to be, so that we can achieve capital gain treatment.
Yeah, and it's kind of like the hook, you know, that it's to keep the business owner involved and continuing. But I think what we've talked about in the past and what I've talked to other experts, it really depends on what that earnout is based on and how much control do you have over, you know, if it's based on a net income or a EBITDA calculation, what are the add backs? You know, those kind of get into those post-closing disputes that happen that, oh, I thought I got an earnout of 500,000, but you're saying it's going to be 100,000.
Right.
How did you calculate that? So sometimes we've said, well, could you have an earnout based on revenue, which is a little bit easier to agree, you know, like this is how much money came in. We can't really disagree on it, but there can always, I think a lot of times a seller is going to be fighting to get that earnout, you know, depending upon how it's calculated.
Yes. Yeah, it definitely tees up the potential for conflict for sure. And I agree with your statement. It's ideal if you can keep it simple and tie the earnout to metrics that can't be easily manipulated. Mm-hmm. Unfortunately, EBITDA seems to be a common factor that earnouts go to, but it could be based on any number of things. A top line revenue is certainly nice. I've seen schedules of customers and retention where maybe there's some type of allocation allocated to those customers. But from a tax perspective, we want to make sure that it is contingent purchase price, which means it's just a way of effectuating the transfer of goodwill from seller to buyer. And then we can ensure capital gains treatment. And hopefully, you know, post-closing, the metrics aren't too complicated to get everyone across the finish line.
Yeah, you definitely don't want it to say like bonus compensation to the owner, like things like that. But normally people are working with sophisticated professionals that kind of help them through that. And getting an earnout based on a revenue is a difficult proposition because, you know, I mean, I prefer it, I like it, but what part did the new owners play to increase the revenue? So it really is like, how do you define it? But I think even in an earnout for EBITDA, you can define it a little bit more. You know, you can talk about what would be the adjustments, but in the long run, it's still going to be something that you're going to have to negotiate a little bit post closing. Whenever it's due, because it could be 6 months, it could be a year, it could be several years, things like that. Absolutely. So another way that things are getting done right now, because there are transactions that are happening, you know, things are still happening. Nothing has just stopped, which everybody kind of thought would happen. But let's say the buyer wants to include a seller note in the terms of the sale. And there are tax ramifications to this, but what that really is the seller financing some of the purchase price. So what do we have to deal with if that's included?
Yes, ma'am. I mean, a seller note is actually a very tax-friendly instrument. I refer to it often as an installment note, and it's a means of spreading the tax costs of the transaction over a period of years, potentially. So, I mean, the seller is left generally with a security interest in what they've sold. So that I think is important. And it doesn't really impact the purchase price allocation. It just changes how quickly the seller is going to receive cash and how quickly the seller is going to recognize the tax consequences related to that. Now, I will say there are some ordinary income items that are not qualifying under an installment sale and would have to be recognized in the year of sale. And that's really in the partnership setting. And the tax code will allow the taxpayer to elect to recognize the entire gain if they thought it made sense in the year of sale. So there's some levers that can be pulled for sure, and timing and other factors that's going on in their financial lives will come into play and have to be looked at from a holistic perspective to figure out what makes most sense for them. Another component of a note is an interest factor, right? So the valuation of the sale can actually increase significantly based upon that financing, that interest revenue that the seller is going to obtain over a period of time. So it is ordinary income to the seller, but it's additional value that wasn't contemplated maybe at the time, of the original pricing of the company, and it generates a deduction for the buyer, and perhaps makes the transaction easier to consummate simply because a lender didn't have to get involved that might impose new requirements or restrictions on the whole deal. So they are very common.
It does leave the seller with some additional risk, because if the buyers can't make that company a continued success, there could be issues with paying it back.
Sure.
But I think maybe I've seen some of these happen to, even if you're close to the end of the year, to move some of the purchase into the next year. I mean, so some of it's tax planning.
Absolutely.
Right. So, there are sophisticated ways to try to do some of this.
Yeah.
Another interesting thing, which we usually will deal with in a valuation, but if the buyer wants to include a non-compete and then also assign it some value, what does this mean from a tax perspective?
Sure. So non-competes are also very common and prudent for the buyer to ensure that the seller does not interfere with the ongoing success of the business that they're exiting. So very common. From a tax perspective, it's treated very similarly to an earnout. It's either considered compensatory or, again, part and parcel of the goodwill of the business. And once again, the language of the provisions and the intent of the parties is prevailing in making that determination. One of the things that I will often do, if the seller is going to provide post-closing services, the easy way to ensure the outcome that we want, whether it's an earnout or regardless with a non-compete, is to make sure that we document or we enter into an employment agreement. Set all that aside, define it separately. And that makes no question, it leaves no doubt as to the capital nature of either the non-compete or the earnout. Now, from a buyer perspective, the non-compete is treated in the same fashion as goodwill. So it's a Section 197 intangible, and it's required to be amortized. So it just comes back to the deal. What makes the deal work? What is the seller's role in the company? Usually a lot of that is determined in advance based upon the current role that the owner plays. How involved are they in the day-to-day and making everything run? And what resources do the buyer bring to the table, to continue that? But again, I would build in an employment agreement where there's any doubt or concern to make sure that we get the capital gain treatment that we want.
Well, and I think the non-compete, are you seeing that they're just kind of arbitrarily assigning a value, or are they doing some calculation for the value?
It is a bit arbitrary, and honestly, a legal counsel has been most involved in assigning values, and I believe those have always been more for a non-tax motive. Mm-hmm. I believe there's more of a enforcement value that might be assigned to that from a legal perspective in case there are issues later post-closing. Right. I try to avoid assigning any value to a non-compete and just encourage and remind everyone that it's going to be treated like goodwill. And, we'll sort through the details based upon what objections the parties might have. But mostly in engagements that I've been involved with, the attorneys if there's been a value assigned, they've done that.
Gotcha.
Yeah.
Well, and I think that it introduces an interesting concept because up until you're selling, usually you have a valuation person involved sometimes to say, what is the value of this particular company. But then as you get towards a deal and an LOI, you have attorneys that get involved, you have tax accountants that get involved, and they all have a different perspective on all of the pieces, but realistically, I think it's best to get all of them involved together so that they can talk about, okay, well, if we do it this way, this will be advantageous from a tax perspective, but this is a negotiation, like all of these people get together and then give a better picture to the seller. Because sometimes the seller wants to keep all of them in a vacuum, right?
Yeah.
Like I'm going to have my lawyer over here. I'll have my tax accountant over here. Sometimes the law firm will run tax calculations. Sometimes not, so I think it's really assembling a good team.
Collaboration is important.
Yeah.
And as you mentioned, there are a lot of levers. So if the non-compete is so important to one party, there may be a give and take in another area. Mm-hmm. And it might not even have to do with assigning values. It could be in the reps and warranties. So there are plenty of opportunities if everyone is talking to find out what's important to them and recraft the deal.
Yeah. And I think that even at the beginning, I've seen sellers that at the beginning get like the team and they're just negotiating at that point. And it seems a little bit overkill, but it's not, because I think you can't just say, oh, I'm going to buy this business for $1 million. And then you get towards closing and you're like, I think I only want it for 700,000. Those are all the negotiation points throughout the whole process. Absolutely. That you need that input. So I'm seeing people assemble teams a little bit sooner so that they can go through and negotiate those terms in a more favorable light, as opposed to going back and saying, oh, I forgot. Could we change that? Could we do this? I don't think buyers really like that.
No.
But we've talked about a lot of different types of companies, but what if you are a shareholder like in an LLC or a private company and they want to buy out your interest so that you can retire, or maybe they just don't like you? No, just kidding. But what are that happens? Yeah. What are the tax consequences for something like that, which is basically like a pass-through entity, I guess?
No, absolutely. So, I mean, the first place I would go is to the shareholder agreement or maybe the partnership agreement, right? Are there provisions in their organizational documents that already speak to value and terms for termination of an interest, right? So in many cases, partner shareholders have agreed to something and they may not remember what it was or have understood it. I would almost rather see silence rather than a specific route, because sometimes the routes chosen are woefully inadequate to capture value for that departing shareholder or partner, for sure. But setting aside the value and the terms, if a corporate example, C or sub S, the biggest thing we need to know is what is the shareholder's basis in their stock. And that can be an elusive number sometimes, depending on the quality of their records and what they've done. And a sub S corp in particular, you have to calculate basis all the way up through the date of exit. So it's a little bit of a moving target. But the proceeds above and beyond their basis is capital gain. So that's a relatively straightforward and good result. There could be state tax consequences, for sure. But the path is pretty well written for them. If the existing other members or shareholders are going to continue forward, their options become a little bit less. In the partnership world, it gets more complicated just by nature of the pass-through entity that you referenced. And what I like to do is create a purchase price allocation. I create a schedule where basically we'll have the basis or book values of the assets, and perhaps even that organic goodwill, because if we know the value, we should be able to calculate the goodwill. We can assign values to these, and the tax code actually requires that we look through to those assets to determine the tax consequences. So even though a partnership interest is a capital asset, without these rules, a partner could potentially convert ordinary income items into capital gain items. So we have these terms called hot assets. It's a term that may get tossed around, but basically they're items like receivables, inventory, and even depreciation recapture. So doing that purchase price allocation with my client, and I like to speak more with numbers and use my board and kind of work through things, but that gives them a visual and a better understanding of what they're faced with and how it works. And then we can quantify what those tax consequences are.
Yeah. And I think that, a lot of times there will be a buy-sell agreement or some type of agreement that may stipulate how you determine the price, but it doesn't really then deal with the tax consequences or how you actually conduct the transfer. Right. And that's where they still may disagree on the price. Right. But all of this is kind of the nuances of negotiating that purchase price. And, we have some that are going on right now that maybe the inventory is a little bit lower. Well, the buyer may have wanted more value in all of those tangible assets because it's a little bit more beneficial to them to allocate it to a tangible asset that can be depreciated quicker, right? Whereas goodwill has to be amortized over 15 years. So that's kind of that's one of the central points of why some of these things are different from a buyer and seller's perspective.
Oh, absolutely. There are other planning opportunities for service partnerships, which you and I probably deal with often. And again, the tax code actually provides for a planning opportunity. So if you have a retiring partner that wants to receive goodwill that's been built over a period of time, the tax code does not by default give them capital gains treatment. They actually refers or defers to the operating agreement. So if in that agreement, goodwill is referenced as a capital gain item for an exiting partner, that's a positive. And I'm often surprised when I see it, because more often I don't find that provision in partnership agreements. So some pre-planning work is really important. I encourage my business owners to review their internal documents, especially as they grow and they add more partners or even more shareholders. It's really important to understand what your documents say and what they mean on a potential exit, for sure. One more comment on the sub S that I find gets skipped sometimes. When you have a departing shareholder, if it's not right at the fiscal end of the company, the allocation to that exiting shareholder is left open. Under the sub S rules, the exiting shareholder gets a per share per day allocation of what happened that whole year. And I always encourage my clients to actually elect a closing of the books, because you don't want to get the allocation for a period, let's say 6 months, of something where you weren't involved. Maybe the performance was better, maybe it was worse. Regardless, it's more fair to do an actual closing of the books. And that gets skipped often in transactions, and then it doesn't get brought up until 6-7 months later when it's time to do a tax return, and someone's getting a K-1 and they're surprised at what's been allocated to them. So it's another, pre-closing event that I think needs to be included in your agreement.
Well, those are actually two good points that I haven't heard before, that language in the buy-sell or the operating agreement and what you just said. Are there any other kind of suggestions you have for business owners that are either contemplating sale in a couple of years or have been approached by a buyer and, they're kind of trying to figure out if they're ready to sell?
Well, absolutely. And all of it comes to pre-planning. Just like when you value a company, you learn so much about the drivers of that company and what makes it valuable. If we do an analysis with the business owner and we do a deep dive into the company and we evaluate where are the risks, where are the concentrations, what are the things that can improve value, we can also identify tax planning opportunities. Some companies are not set up well for a sale. There are some companies that I know a high probability will be an entity sale. There are others that will be an asset sale, but they may be structured in such a way that is very unfavorable. If we have some lead time, it's possible that we can convert the tax structure. It's possible that we can introduce some planning concepts that will make the eventual exit a far better outcome than if we did it today. So planning is everything. People work so hard in their business to build it. They spend years and years. Exit planning should occur years before that exit if they really want to capture value and walk away as best as they can.
Well, and I think that business owners, will hear, especially people like us, talking about some tax planning or getting a business valuation, a few years before you want to sell. But it really is the first time that a third party kind of comes in and pressure tests your financials, asks questions. Most of the time when we come in to ask questions, I know you know this, it's the first time that they've ever been asked that question. They've never seen their 5 years of financial information spread in an Excel spreadsheet. They didn't know what happened in 2018 to that particular expense.
Right.
Things like that, I think they're just become more aware of. So a lot of times when we do some of the pre-sale valuations, we're coming up with things that do need to get fixed before you sell. Like those are the skeletons in the closet.
Absolutely.
That the owner might not have even known about.
No.
But that also leave them in not a great light when it starts to be discovered by the buyer. So then the buyer comes in and says, well, what the heck happened here? And they're like, I don't know. It tells the buyer more about that seller that he doesn't really, or he or she doesn't know what's happening in the company.
Sure.
They're a big issue.
Yeah, they're too close to the situation, and that could be for any of us. And like you said, get the cobwebs out, spin the negatives to positives, create opportunity where it looks like there might be a disadvantage, mitigate the risks that you can, tax plan appropriately.
Well, and sometimes, I don't know if you'll notice this, but sometimes most times business owners think their company is worth way more than it might be. Unless, we were talking about this earlier today, unless they're getting divorced, then it's worth nothing.
Yeah. Well, it depends on which side you're on.
True. Very true. But this has been a good conversation, Brad. But I think if people want to reach out to you, because I do valuations, you do valuations, but you really have a better grasp of the tax planning, the tax ramifications, and the structuring of this deals. Just tell us a little bit more about your background, your company, and the other types of services you provide, because I think people would want to reach out to you and ask you some questions during this time.
Oh, sure. So, I mean, my background as a CPA has historically been tax. That was the direction that I started. And in doing that, every planning transaction, every financial transaction that we undertake has a tax side to it, has a tax component. So it's a natural planning environment to be in. We work with businesses and business owners. That's our focus. We have an accounting team, we have a tax team, and then I'm kind of the quarterback in the middle that helps pull all this together with valuation. And transferring business interests. That's what I love to do. So it brings a lot of skills together, and it's very proactive and dynamic. So we certainly coach our business clients as how to increase value, right, and prepare them for sale, and then we can also be there to help them walk through that exit when the appropriate time comes. Some of our financial planning efforts involve retirement plans. So I am securities licensed, and we do set up cash balance plans, profit sharing plans. We look at ways to incentivize key staff so that we build a very robust package for continuity. There are planning opportunities for the owners that actually where you can accrue benefits that could be deducted in the year of sale and help offset what would otherwise be large tax implications. So there's a lot of things that can be done, and that's where I enjoy spending time. And every client's different, every objective is different, but that's our job, is to help sort through it and find the best route.
And I think it's important to note because most of the time professionals kind of stay in their lane and do what they do well. But I think that really sellers are doing a little bit of a disservice if they don't reach out. Sometimes they have their accountant that may be doing their books and things like that. But if this is if you don't have an accountant that's really dealing with transactions on a monthly basis, things change. We're in a crazy time where things are changing dramatically. I think you just can't assume that my valuation person or my attorney or my CPA will have me covered. I think you really do have to find somebody that has the knowledge of transactions from a tax perspective, because they're doing a lot of transactions. That's a very different piece, because when this transaction is done and you've sold that company the one time in 30 years, you can't just go back and say, ooh, I wish I could have gotten 20, 30, 50, 100,000 more. You can't go back and do that. And you might not even know that you could have had that money if somebody didn't plan. But I appreciate all of your great information, Brad. If you have anything else to let us know, that would be great. If not, we're going to put all your information, contact information in the video and the podcast. And if they want to reach out to you, I keep on telling people to reach out to professionals right now, since we're kind of stuck in our offices and we can't see people very often. So hopefully they'll reach out to you, but we appreciate it. And this was valuationpodcast.com.
Thank you.
Thank you.